Morning, everyone. Welcome to this morning's edition of the MPC Markets Morning Call. It is the Friday, the 24th of July. I'd like to say happy Friday, but not so much. Investors, US investors, finally woke up to the absolute pile of risks that are going on in the market. For anyone who watches the podcast, the Morning Call podcast regularly, or our podcast from a couple of weeks ago, we've flagged these risks. But it's one of those symptoms of a bull market nearing an end, where everyone just puts acts like an ostrich and just puts their head in the sand. So Tesla, very disappointing earnings yesterday. They ended up down about 14%, but more concerningly, Google down 7%. And then the knock-on effect of that was Amazon and Meta, which are reporting next week, which will almost certainly have far worse CapEx numbers, I would imagine, than Google. But slipped sort of in not in sympathy, but in preempting. So all of the green on the screen is essentially you're either receiving the checks from the hyperscalers, or you're a defensive sector, essentially, or you're in the oil sector, because as much as the US and I listen to US media on the way to work every day, multiple streaming channels, they have just categorically and irresponsibly been ignoring the Iran situation over the last 2 weeks. It's now coming back to haunt them pretty badly. We saw Brent through 100. We saw WTI well through 90. And to be honest, it's not even, it hasn't even started warming up yet, I wouldn't have thought. Look, just a bit of a pre-warning. We're only 2 minutes through, but if you're looking for some good news, then probably, it ain't going to be in the rest of this morning's morning call, except for this one shining light, which was Intel. Data center was the star. Revenue up 59%. They beat. Their guidance was strong. Their capex is rising, but it is to meet demand, and their turnaround is gaining traction. The Lip-Bu Tan, the CEO, who's actually pretty good, because Intel was the simple cousin of the chip sector for many, many years. He's actually doing a really good job. The PC segment sort of grew as well, but it was really AI data center driven. They've got that new 2 nanometer fab coming as well, which Elon's helping with, which gives another bit of confidence, but it's up around about 9% after hours. But having said that, it has dropped a fair bit from its highs. One of the key things the analysts were saying, and I've got to say, everyone's beaten kind of this week, except for, I think even Tesla beat. It was just other factors, but it was essentially no one's been overly enthused about it, and Intel just does CPUs, so there was a lot more talk about AMD, to be brutally honest, that if Intel's doing this well, AMD should kill it, and it wouldn't classify as it certainly wouldn't classify as in their top picks for that sector. So we're just going to have a look at this Alphabet or Google. So the big talk yesterday was around the obviously around the capex, and then the fact that they have had their first ever negative free cash flow quarter. So this is where hyperscalers become and they're not hyperscalers anymore, because their revenue was growing from this FY18 all the way through, and their capex wasn't expanding, but their revenues were expanding. So that's the pure definition of a hyperscaler. Now, negative free cash flow, they're just hyper spenders at this point. Not to say that, I mean, we're still using Mag 7, and that doesn't really apply anymore. But yeah, it's the first time free cash flow turned negative, but they still had strong top line growth in cloud. But markets now pricing in the AI arms race cost, not just the upside, which, for anyone who's watched any of our podcasts, we've mentioned ad nauseum for quite some time. So that, I think I may have the wrong one there. Yeah, because the Nasdaq was actually down, and let me just get you the correct numbers here. Nasdaq was down 2%, and we had the S&P down 1.2 overall. So apologies for for having the wrong one there. And the overall, we're a hell of a lot more negative. We're a strong sell in the Dow and the S&P now on the daily, and we're a sell on the Nasdaq and the Russell. And if you're looking at Nasdaq, I think the Nasdaq 100, and the Nasdaq composite, we fell a fair bit further, across those indexes. Intel will slightly save it. But look, now we've got both Hormuz and Bab el-Mandeb. I've had to practice that one because it's going to be be mentioned pretty often for the next bit. But they had there was the Houthis struck 2 Saudi tankers in the Red Sea, first since the blockade was declared. Hormuz vessel crossings are now down 75% from already horrible levels. About 1.9 million barrels per day in refining capacities exposed. 12th consecutive night of strikes in Iran. Tehran, were hitting bases in Kuwait, Jordan, and Bahrain. People sort of asking, why they're hitting their neighbours. Well, the reason they're hitting their neighbours is they're surrounded by US bases. So yeah, we're back above 100 for the first time since May. We're back, up 40% year on year for oil. And look, basically with that strait close, the Bab el-Mandeb closed, it's essentially now they've got to go through the Suez Canal, through the Mediterranean, around Cape Horn, South Africa, to get to Asia for fuel. Well, and it's not the only thing that comes through that strait overall. So it adds an additional 10 to 14 days per, one way, so nearly a month. Freight and fuel insurance, and that's a little bit hard to read. I should have made it brighter, but costs are estimated to be able to effectively be up by 30 to 50% for affected cargoes per ship. Fuel, insurance, time, extra miles, we're talking anywhere up to 6,000 nautical miles. And then, add to that, American strategic reserves are at 46-year lows. And they basically will be, they're in trouble, but essentially, and then add to that again, the Trump's announced tariffs on everyone again last night. Australia has even been tariffed 10 or 12%. He's had a crack at Canada, so I don't know. I mean, it'd be silly to think that he's purposely trying to drive inflation higher, but I don't think there's much more he could do to drive inflation higher. It's not policy; it's just suicide, political suicide. So you got gas prices back above. I think they're averaging about $4.10 per gallon in the States. Diesel's even worse. Fertilizer's going to go through the roof. You've also got natural gas. And look, even in the background, which is pretty speculative, if Putin does up the aggression level with Ukraine, this is a categorical disaster. So look, we've had gold, silver go back to that stupid risk off thing again. It's long term will be a buying opportunity. We'll all probably look back on this period and go, why the hell didn't we buy an absolute truckload of gold and silver and copper and platinum at this point? But it is what it is. The reason they're down is we had 10-year yields hit an 18-month high at 4.7%. 30-year real yields are the highest since the GFC, nudging 3%. Money markets are pricing in a 35% chance of a Fed rate hike next week, up from 10% last week. US dollar just keeps strengthening, and then the dollar yen's at a new 40-year high. JGB yields are the highest since 1995, and the ECB is expected apparently to to be hiking rates, next meeting, and Lagarde's basically said that she's left the door open for a September hike. Gas prices in Europe are up 60% in the last month. And then add to that, initial jobless claims fell to their lowest level since 1970. So the economy is technically very strong. I think, with all of this going on, and this is, I sort of have not been of the opinion that I think there are a massive chance of hiking next week in the US, and that's just going to take the wind out of the sails of everything. And we've obviously got Meta and Microsoft and Amazon reporting on Wednesday and Thursday, so you can expect another horrible capex number and more talk about free cash flow. Essentially with free cash flow, it's just like you're not going forward, and you're spending too much versus what's coming in. It's not overly technical, but go and do some research on that, because I'm telling you now, it'll be one of the most, no one's going to care about revenue or EPS for the next few, for this earnings season. It's just going to be all about CapEx for those hyperscalers and that free cash flow. So, and they're all going to be negative free cash flow by next year. Well, we'll get some, brighter news towards the end of the week with Chevron, Exxon, and we've got a couple of the Aussie, the big miners, Rio and Fortescue next week as well with their earnings. There was some bright notes for the defense sector, and we've been telling people to get back into the defense sector for quite a while now. Lockheed Martin was up, considerably last night. Was up 10.5%. It smashed it. Raised guidance, record backlog. RTX was up 7.5%. Raised top and bottom line guidance as well. Intel was up after hours, and Micron was up 3%, and SK Hynix was up 2%. Micron must publicly thank them for very significant memory allocation on reasonable terms, but SK Hynix. So again, what we've been talking about for weeks and weeks and weeks, the people receiving the checks are going to go okay, and there's not many of them, I've got to say, and the people writing the checks, just get out. Basically, I don't normally, general advice only, but I mean, if what the risks that are going on here at the moment with the market at record valuations or very close to record valuations, if this doesn't prompt you to get out, I don't know what will. So, and the market's really starting to wake up to that. Add to that, 1.5 trillion in retail leverage, these stupid 3 times ETF. Are even making retail even more leveraged, and I just I try to be a little bit optimistic, because we all know that markets go up long term, but you need to be reducing your risk here at the moment, and looking to buy the dip, because there is every chance that we're gonna be 10, if not 20%. Lower at some juncture. Have a listen to the podcast this afternoon. Bulls versus Bears, EP 129, hyperscalers or hyperspenders. And we've got a new team member, Philip Delockery, and he's going to join me on the morning call every now and then as well. Coming up, very experienced trader, and will be the big reveal for him this week. So we'll have bring a bit of experience, a bit of class to the panel. Overall, but yeah, it should be a pretty good one this week, and there's also a very special correspondence edition. JT sent in some photos from his research trip to to Southeast Asia, so tune in for that. But look, given the market is what it is, if you're holding S&P 500 or FANG or Nasdaq ETFs, etc., like I said, probably not a bad time to be selling them. But if you want to try and buy the dip, and you always freeze every time it happens, go and have a look at buy the dip. It's our strategy essentially that we package up and we use options, and you have a defined entry and exit, 3-year deal. you only need to put down $17,000 to get $100,000 exposure. That leverage only works to the upside. It's buying calls and not to the downside. So you're sort of capping your notional exposure there. And we put it in a special feature called a look back, which means the lowest close on the nominated day of, which I think is going to be a Wednesday. The lowest Wednesday close between now and November will be your entry price. So you don't even have to worry about buying the dip. This thing will automatically do it for you. It's a fantastic feature. It's one of our most popular products, and really, if you do the maths, it'd be, it makes these sorts of strategies and structured investments are the new era of how to invest. And I think holding traditional ETFs at 1-to-1 with no risk and no entry, optimized entry, is essentially the equivalent of continuing to go the horse and cart. When you've got access to a car, basically. So yeah, go scan the code, go to the homepage. It's everywhere at the moment. It will close next Wednesday. And for those of you who are retail, not sophisticated, we won't be running this again this year. So you probably want to get in on this round. For sophisticated investors as well, it's available and a little bit cheaper. But look, not going to be a great day. SPY's down 50. I mean, we've got, and another service that we have obviously is free portfolio reviews. Just go to the homepage. It's a button in the middle of the screen. Fill in the form, upload your portfolio, do it today. We'd probably get back to you. I would assume, given the level of urgency, we'd probably try and get back to you by Monday, and I'll get a few done over the weekend if you'd like to do that. No obligation. We're not going to hassle you afterwards, but we've made some really good proprietary software that'll help you through this period, because these are the moments where you need to be decisive and really be managing your risk and not putting your head in the sand like US investors have been doing for the last 2 months. Make sure you tune into the podcast. It'll be good content today, and a good oversight on the general market. That'll be released on your favorite platforms on YouTube, Spotify, Apple Podcasts, blah, 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 around about 6 o'clock. But look, apart from that, have a great weekend, people. And we'll see you on the Bulls versus Bears this afternoon, or we'll speak again on Monday. Cheers. Very good at that.